Toppen. David Wendel, First Venture.
Thank you very much, Lars, and good morning, everyone. Thank you for joining me this morning and for showing an interest in First Venture, Sweden's probably most interesting venture capital fund at the moment. And during the coming 20 to 22 minutes, if you are to believe Lars, and I will try to hold it, I will try to explain why it is so interesting. I will explain how we work and why we most likely are an interesting investment case for all of you. My name is David Wendel, and I'm the CEO of First Venture. And before I show you the slide deck, I want to emphasize something, because there are a lot of VC firms out there, but we differentiate a lot from most of them. We have history, we have a track record, and we have a a continuous investment strategy that is quite unique. If you were to meet us 5 or 10 years ago, I would have given you almost the same pitch on our investment strategy as you will hear today. And I would tell you that we were a VC fund that were to create unicorns. Some of you would probably have believed me, some of you wouldn't have. But standing in front of you today, we have a track record to show. We have almost produced our first unicorn, and my vision for this company is that this will be the first of many to come. So with that kind of bold introduction, let's move on to First Venture. And starting with putting us into context, well, First Venture is a venture capital fund. We are publicly traded, so this is hopefully of interest for you. We invest in startups and scale-up companies within these 3 sectors: technology, sustainability, and health. And the reason why we chose these are quite simple to explain, but I know that the definition of these sectors are quite wide. But the way we navigate within these sectors are with pinpoint accuracy. But starting off why these are of particular interest for investors, one, these sectors, or the companies operating in these sectors, have a chance to actually bring a positive impact to the planet and to the people walking the earth. And I know that all VC funds or investors that you meet will have an ESG slide. Everyone must have that now. But for us, we have a track record and history of this. We've been doing this for 15 years, and this is really at the core of everything that we do. We want to be a part of something positive. It's not just something we say. And the proof of that is our portfolio that you will see in a few minutes. But apart from actually being part of something good and something positive, these sectors and industries also have a great financial upside. These are so-called megatrends. And what that means is that they're currently undergoing rapid and fundamental change, mainly driven by technology, digitalization, automation, machine learning, AI, and blockchain. And when these kind of big industries undergo rapid and fundamental change, it invites smaller companies to take quite a large market share in a much shorter period of time that was ever heard of before. And that is really interesting for companies like us, because we can reduce the time to bring great returns to our investors to a much shorter time than was ever possible before. And in addition to the speed in these sectors, they're also well-established multi-trillion dollar industries. So the combination of the speed of small companies and the possibility to acquire a market share that it doesn't have to be huge to still gain great revenues in a relatively short period of time makes these really interesting from a VC perspective. But of course, it's not enough just to highlight 3 sectors and say that we have nailed down the strategy. It's important to navigate within them. And coming back to where I started, we have the history. We're 15 years, which is quite a lot in the VC industry. We did a rebranding or a revamp of our brand back in 2017. We were founded as Första Entreprenörsfonden. Today we are First Venture. And this rebranding was part of the journey for us to becoming a publicly traded company. And that we became in July as of last year. Now, there were many reasons behind this move from a private VC fund to a public one, but the one the one reason that I'm the most proud of is the fact that we at First Venture, as the first VC fund within our space, we're driving a democratization of investments in unlisted companies. Because we all heard the stories about Swedish startups becoming unicorns, about founders becoming billionaires and spillover effects making employees and investors very wealthy in a relatively short period of time. And I would have loved to be one of the first investors in, let's say, Spotify. The problem for me as a private person is that I usually don't get that type of questions for unlisted companies. But today, as First Venture, we do. We meet the companies of tomorrow, the big game changers, on a daily basis, and we get a chance to invest at a very early stage. And since we're a publicly traded company, everyone get a chance to be part of this journey. And since this appeal is quite big, the retail segment or private placers out there, they found a big interest in us as well, which helps our institutional investors feel safe about the trading volume of our stock. And I wouldn't be doing my job if I didn't mention the entrepreneurial soul, because what we're working with company builders, or that's what we are. And every single one at First Venture are or have been an entrepreneur themselves. That makes us better suited to guide and help the companies that we invest in to become bigger in a faster pace. And this is, of course, a great way to build revenue, but also a way to mitigate risks. We can be there for the companies, helping them navigate the pitfalls of a startup. But how do we invest, and what is our approach to this? Well, First Venture invests in listed and unlisted companies. We only invest in companies with high growth potential, because as we started out saying, these sectors have a big offering of very exciting companies that can generate revenue and returns in a relatively short period of time. And the third bullet here, entrepreneurial teams, it might sound like a given, like something you're supposed to say, but for us, this is really the secret sauce. This is what sets us aside from a lot of the other alternatives for VC funds out there. We are entrepreneurs ourselves. We've been working with this approach for 15 years, and it might sound like a subjective mumbo jumbo. How do you know if someone has the right characteristics to run a company? But it isn't. This is actually science. And before we invest, part of our investment and due diligence process is evaluating the entrepreneurial team and founders based on 18 different characteristics. We evaluate them on an individual level, but also as a team. And by doing so, we know that they have the right characteristics to navigate these companies. But we have a possibility to make sure that we, as an investor, have something more than just financing to contribute, that we can be a part of driving the development of the company, which leads into the active investments. This could mean that we invest a lot, but this specific bullet means that when we invest, we are active in the companies as a general rule. We take board positions, we're part of building the strategy of the business development side, building networks, distribution, and making sure that the companies can live up to the high potential that we scouted out. So that is, in essential, the investment strategy summary. But as Lars was talking about, it's not only about finding the right companies, it's also about timing. And for us, value of death is really the crucial or sweet spot in terms of timing of investments. Most of you have probably heard the term value of death before. It was coined in Silicon Valley, one of the meccas for VC funds. But since this is a crucial part of how we generate returns, I want to walk you through this real quickly. If you imagine the traditional startup or scale-up journey, everything starts out with an idea. And then you have some research, some development, you launch the product or service, and it moves into a commercialization phase. And the last phase, that's where we actually make the money. The problem with starting a company is that it is connected with costs, but you don't start to have any revenue until you launch the product. So we all know that investments are needed. It usually starts out with the funders, friends and family, maybe some incubators. But the costs are growing at a snowball effect or exponentially. In the beginning, you can work from home with a small team, but as this idea grows, you need to accumulate additional costs. And I know that all of you love graphs and statistics and numbers, so let's throw an accumulated cash flow curve onto this. You start out with the initial investment, and the costs keep accumulating and growing, eating up the initial investment. So way before the product can be launched, companies in general need additional investments. They turn to the angel investors, which are a great complement. But as a general rule, they cannot bridge the full way until the company starts making money. And as you see, if you manage to bend this curve, to turn the trajectory to the northeast, that's the point when the product starts making more money than it's burning. At the bottom of this valley, you have what's called the valley of death. And in order to break the curve, that is quite tricky to do. You need a lot of hard work, you need knowledge, and you need funding to build marketing, distribution, team, and growth. So this is usually the spot where early VC funds, like First Venture, comes in with the investments. And this is where we generally operate. If we inject capital, knowledge, and network into these companies, we can help them bend this curve. And that is the point of product success, making more money than you're burning. And if we follow this trajectory, at some point, we will actually be making more money than was initially invested in the company. That is the point of business success. But from a First Venture point of view, and why I believe that we have a great value offer for all of you, the sweet spot for us is really within this sort of triangle. And the reason for this is twofold. One, for the entrepreneurs, at the bottom of this valley, that's when they need us the most. They need the capital to fuel the company, but they need the knowledge to make the company grow. And for the investors, you can imagine where the valuation of the company is at its premium from an investor point of view. If we time this perfectly, we will invest in the bottom of the valley of death, and we will ride the wave all the way up. And that is how we can generate quick revenue and returns in these megatrend areas. And at the same time, be helping the entrepreneurs when they need it the most. So what does this mean in practice? And if we apply this for 10, 15 years, this is the result from First Venture. This is our current portfolio. We have 14 holdings as of now, 15 being publicly traded and 9 of them being unlisted. Lykkegård is about to make an entrance to the public scene in a few weeks, so then we will have to redesign this slide a bit. And I would love to talk about all these companies because I honestly love all of them, but I wouldn't be keeping the 20 to 22 minutes I promised Lars, and I would be thrown out, so I promise I won't. And again, I know you guys love numbers, so let's look at the portfolio this way instead. This is First Venture's portfolio as of last of December last year. And the reason why I don't have an up-to-date figure is, of course, the unlisted holdings. We don't have daily valuations on those. So as you can see, about 2/3 of our NAV is currently in placements, and about a third, 32.2%, is a cash position. And we will get back to the 126 million shortly. But this is the portfolio. Our biggest position as of now is Humble Group. And I promised I wouldn't talk about all of them, but in order to show you how this investment strategy is executed in practice, I want to highlight 3 different companies. And given the size of Humble, I of course want to talk about that. But I also want to talk about 2 of our latest investments, which is Mendy Innovations and Alelion Systems. So let's start with Humble Group. For those of you that don't know Humble, it is a Swedish publicly traded FMCG group. They have a vast range of products from sustainable beauty, bamboo toothbrushes, to sugar reduction and healthy snacks. This company has been built through a compounding or an M&A strategy for the past few years, and quite successfully so. But I'm not here to pitch Humble, even though it is a really exciting company, and I urge you to check it out. I'm here to pitch what First Venture had, or our role in Humble Group. So I told you that we're an active investor. And Humble is a really good example of this. We invested 10 years ago. We've been part of driving the strategy, everything from the initial one to the compounding or M&A strategy that was put in place a few years back. We've been holding board position. Peter Wärme has been the chairperson of Humble for I don't know how many years now. And we've really been a part in developing the team as well, because it's one thing being a leader of a small-scale sugar reduction company compared to a huge FMCG company, publicly traded with 25 subsidiaries. So we're also there for the entrepreneurs, helping them grow into their new roles. And we've been doing so with Humble from day one. And as I said, this is 10 years ago. The usual VC fund have, for mainly tax regulation, a pressure to remove or make exits within 3 to 5 years. For us, we could have had that approach with Humble. We would have had a great return in 3 or 5 years as well. But we stuck to it, because as long as we see a big potential in the companies, we will remain as an active investor. Has this been a good approach from our side? Well, we invested in Humble at a valuation of 8 million Swedish. We purchased 30% of the company, roughly. And as of, I think this was yesterday's numbers, they're valued at 5.6 billion. And most of this growth has been coming for the past 3 years. So we could have made a decent return in 3 to 5 years, but we would have missed out on the big jump. So the long-term commitment combined with the active investment strategy can really yield some great returns. And as I said, the past 3 years has been the main driver here. And this is, of course, our Soonicorn, and hopefully our first unicorn. So that is Humble and our active way of investing. But moving on to the most recent investments, or some of them that we made, Mendy Innovations. This is also a Swedish company at the intersection of health and deep tech or deep technology. Essentially, Mendy is a combination of a hardware, the headband you see to the right, and a software on a mobile application that you have on your smartphone. What you do is you put the Mendy headband on, and it starts to read the brain activity and blood flow in your frontal cortex. And the frontal cortex is the part of the brain that makes us human. And this data collection is being sent to the software, where you get daily training exercises for your brain. This is also a really cool app. I wish I had time to show you all, but inside the app there's also a game, and you control it completely with your brain. You never touch the screen. You just look and focus, and that's how you navigate in the game. So the technology is just fantastic. But again, I'm not here pitching Mendy. I'm here pitching our selection of Mendy and how this fits into our strategy. I said that this meets two of our focus areas. It's deep tech and it's health, brain training. Mendy also consists of an incredibly strong team. They come from a background where they really understand the problems and challenges. They found a solution, and they've built this device and software in a beautiful way. But it's not only us loving Mendy. Before they came to us, instead of going to angels, they tried a slightly different approach. They went for crowdfunding. So they launched a Kickstarter campaign, and Kickstarter is probably the biggest crowdfunding platform out there. And in 1 week on Kickstarter, Mendy became the biggest funded company in Kickstarter history, globally, within the health and brain training segment, which is kind of cool. And they sold 10,000 units before they had to pull the campaign from Kickstarter because they needed to be able to deliver the products. So it's not only us loving Mendy, it's also the retail segment or the end customers. And of course, we like to bring forth some other endorsers of the product. NASA, the North American Space Agency, uses Mendy as part of their astronaut training for the mission to Mars. And of course, a lot of reputable hospitals are testing this as of now. So Mendy is a really interesting product. And now we only talked about the basic use for it. The last bullet here is also really interesting. As of today, Mendy is the world's biggest single database for neurofeedback data. And we all know the value of data in these days. This isn't being used at any particular way right now. And of course, there are a lot of user approvals that needs to be obtained before launching it. But just the sheer size of brain data in this company is staggering. So a really interesting company. But moving on, we have Alelion, a company we invested in a few weeks or months back. Alelion is a publicly traded company. You might know it. They help other companies transition from gas-guzzling fossil fuel engines to electrical ones. So when we buy a personal vehicle for ourselves, we have a lot of options. We can buy a Tesla or a Polestar or a Fisher. But for big machines in docks, airports, and construction sites, that's really not an option. Everything is tailor-made for the specific use. What Alelion does is switch out the combustion engine to an electrical one and tailor-make that solution for the specific purpose. So again, a great combination of sustainability and technology. It fits right into our space. And it is really a full-service transition house. They help with the design, the implementation, the building, and the education of the products afterwards. As Mandy, Alelion consists of a really strong team. Otherwise, we wouldn't be backing Alelion Systems. But we really believe that they have something unique in the composition of the team, which is shown in the figures from the Q3 report. Over 300% net sale increase year on year for the third quarter, and big orders coming in for this year. And what's the upside with the first venture? Well, given our way of working, that we are an active investor, we will take one of the board positions and we will be part of building this company for the future. We get quite attractive options in buying into even publicly traded companies. So for Alelion, for example, we got quite a big discount. So even with this week and with the opening we have today, or already had, we still have quite a big profit on companies like this. And we believe in them for the long run, but even in the short term, with our approach of listed companies, we have a possibility to make some pretty decent returns in a few weeks. With that said, the last two slides, going back to this, I would love to talk about all of them because they are truly amazing. And they are high growth potential companies, all of them. But I promised you to talk about the 126 at the lower right before I let Lars back on stage. And this is quite a big cash position. And I assume that a lot of you have a similar situation with your own investments. This is a volatile market, and having a big bank role at this point could actually be quite good. We are open to finding listed companies that are very valuable right now, but we also have a big bank book to roll these unlisted companies. And we will be using this money for exactly that. Follow-on funding with the current portfolio. We will find new unlisted companies that we believe in and do some public equity or stock market trading with them. So we know that having this kind of money on the bank isn't really the best investment, so we're hoping to use them as soon as possible. But we only invest in high quality companies, so as long as or until we find them, we're going to keep them in the bank, even though it might not yield the biggest return in the short term, it will in the long. And I hope that this has triggered your interest for a first venture. If it hasn't, I have one last slide to probably convince you at least to check out the stock market. Analyst Group made an analysis. It's about a month old. And this is the investment companies being traded on the Stockholm Exchange. You have first venture to the far right with by far the biggest discount on net asset values as of now. And if you add everything I've said with the long history, 15 years in the game, the experience and the way we actively invest in the companies to reduce risks with the current discount, it is, to me, a very interesting investment opportunity. And as Warren Buffett said, price is what you pay and value is what you get. And keep that in mind when you look at this and the numbers that Analyst Group predicted for 2022. We're currently trading at, I haven't checked today, but around 6.2. So with that said, thank you for listening. and welcome Lars.
David, thank you.
Thank you.
Very, very interesting. David taught me a new thing when we checked each other out before this ProHearings. ebindex.se,
Yes.
isn't it?
Yeah, it's a very interesting site, and this graph that I showed you is from ibindex.se, the investment companies or investmentbolag in the Swedish market. So if you're interested, check it out. We will be published there in a few weeks.
Is it true that investment companies discount to book value, or, I mean, they can be above book value or below book value, but the discount goes up when the market goes down? Is that a general rule? Is it always so?
Not always so. For some, I think it's company to company. For us, I mean, we have been publicly traded since July, as of last year. For us, it's a bit too early to say, to be honest. And I think it varies company to company.
Yeah. So you're small compared to Investor and Industrivärden. You're
For now, yes, but give us a few years.
Hey, I like it. Yeah, and your cash position is like 45-50% of your market cap?
About 31 as of now, 31. And these numbers, again, they're from last of December. We had quite a few interesting investment since. Y-Trade, or J-Trade is the product, a publicly traded company, as well as a follow-on investment in Lyckegård. So it's actually quite, or a little bit smaller than that, 126.
Yeah. You had a very interesting slide, the slide with the value of death.
Oh,
I
love it.
Pull it up.
Absolutely. That's probably my favorite slide as well.
Ah. Yeah, yeah. You have the Chinese edited version. The adult version is friends and family. There's another F.
I know. This is
3F. Friend, family, fools. Yeah, the first investors. So you let them take the first hit.
Yep, and then we can evaluate in the downturn.
Yeah, this is very, very true. But what is very, very hard, and you can give a long answer to this, how do you know this? I mean, some just, it looks easy enough, but it can just go straight to hell, or in a curved way to hell. 7 stock offerings later. So how do you know? Talk about this. What's the sign?
That is our secret sauce, and I'm not going to spill too much of it, but it's a very, very valid question. The vast majority of companies that are in the valley of death will die sooner or later. Some of them get some CPR and survive for a year or two, but eventually they die. But the vast majority doesn't make it. And at the same time, I would say 99% of every company on this earth has been in the valley of death at some point, because that is how you scale and grow. If you don't do it, if you try to avoid it, you will be going flat. You won't be boosting revenue and sales. So it's a bit of a paradox. Everyone needs to be there, but if you are there, the chances are you won't survive. So for us, one part is the analysis, reviewing the company, seeing how far along they are with the development and launch of the product. But of course, that's only one part. The other part is what we can bring to the table. So we know that with the analysis, we know where the companies are on this trajectory. And we know that if we move in right now with the capital and the knowledge and network, we can boost marketing and we can boost the distribution network, and we can push this product into 10 new markets. And that is really how we help bend the curve. So it's not only a passive investment. If it was, we would only be analyzing. But since it's an active investment, we're actually helping bending the curve to making it more favorable to the entrepreneurs, us, and our investors.
And the game is meaner than ever. I actually, long time ago, I ran a mobile services company, around 2000. And back then, you did a quick and dirty hit. You made a cheap programming, and you saw what happened. And if it caught on, you made a nice version. It was interfaces were horrible. Sorry, Niklas. You could do it better, but I couldn't pay your bill back then. So that's not possible now. With all the big data available, Google, Apple, Microsoft will kill you by stealing your nice idea and making a perfect version with 300 consultants spending 2 years. So how is that done, 2022?
Well, I think just to add on to that before answering, I think that's one aspect of it. Another one is that the customers are more disloyal than ever. Looking at, I mean, my parents' generation, they found their Levi's 501s, and when they found that perfect fit, they bought the same pair of jeans for their lifetime. Customers today isn't working like that, and that goes for, well, softwares and services as well. If something isn't working, if you have a poor interface, people will leave, and before giving it a second chance, you wouldn't have to give it months or years before people actually consider coming back. So if you do that, the quick and dirty version of it, you risk losing a lot. You're exposing your idea so big players can outrun you, and you lose customers. So it is a big part of actually analyzing and doing the due diligence in a very detailed manner, knowing that what we put our money in is more than just a quick fix.
Yeah, so you're saying the quick and dirty that we did back 22 years ago wouldn't fly anymore. You need to spend more money.
It wouldn't work from first venture standard, at least.
It's on.
It's on. Your current holdings, especially the Humble Group, where are they on this curve?
That is a great question, actually. And if I had more time, I would draw up the full cycle of this, because usually you have not one, but several of these. If you look at the traditional company, this is the startup phase, the first one. And then you start growing, but then the company wants to launch another product or enter several markets, and then you have another valley of death later on. So this is kind of a staircase, and it is an interesting question since we do follow-on investments. So it's not only the initial investments that we want to time in this, we also want to time the follow-on investments in a later valley of death, because then we can maximize the return again and again and again and multiply that effect.
Oh, now there's another valley of death back here.
About a bit more concrete, please. Are any of your holdings profitable? Are they any of them above the?
Definitely. And sorry for not answering. Humble Group, we invested 10 years ago, and then they were around here. Then it was a sugar reduction company. It wasn't called Humble, it was called Bain. And the solution was amazing, but it was tricky to sell it to the industry. So that led up to the business development side that led to a compounding strategy. So Humble were probably, we thought they were here. Probably they were about here somewhere when we invested, earlier than we wanted. And then together with the company, we could bend the curve, but it took longer than expected. And now, I mean, it is a business success. With the compounding strategy they're acquiring profitable companies, and now it's 25 plus within the group, actually making a lot of money.
Talking about Humble Group, the share price has gone up quite good on that one. But I was looking at your share price on First Venture, and it seems it's on the left side going down in the valley of death. And how is it with if you compare the substance valuation during that time, the last year or something like that, how is that compared to the share price then? And why is the share price going down?
A great question. If we look at the net asset values as of now, at the last quarter, we only have the figures up until last of December since we have the unlisted ones. But looking at the last quarter, we have an increase of about 8% in net asset value. At the same time, we see that the stock price is going down, so the discount is actually increasing as of now. And then the big question is the why. Why is that happening? We're generating and we're creating revenue and wealth, but the stock price is going down. And I mean, it is the market. There's no easy, quick answer for why the share price is going the way it is. I believe that it's on us. We're not out doing this enough. We're focusing on building wealth in the portfolio companies, and we haven't been that great in actually meeting the market. And that is partly why I'm here today. But we need to talk about this more because we have the track record, we have a fantastic portfolio of companies, and we are actually generating positive returns.
How did First Venture share price do this year, January 1st till now?
Let's check. We have 20 minutes of today, and we're negative, so red numbers as of this year.
Yeah, like almost.
Since Monday,
Everyone.
it was
Yeah.
Minus 17%
yeah.
this
Yeah.
year.
Yeah, so that's high risk, perceived high risk. You're not that high risk, really. Okay, time flies. Anyone has a last question with a short answer for First
Can't
Venture?
promise a short answer.
Okay, so thank you, David. Thank you.
Thank you very much.
First Venture.